Be Wealthy and Smart, episode 1031.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about, is the correction over yet? Because this has been a very volatile time, and that happens from time to time in the stock market. And I like to remind people that that's why we're able to get double-digit rates of return over the long term, because the stock market has volatility and fluctuations, and frankly, scary periods of time. Because we put up with all of that, we're able to get 10% over the long term, versus putting it into a certificate of deposit at the bank, not having any fluctuation, and earning, well, probably around 1%. So today, I want to share with you some reasons why not just I have optimism for the future, but where I'm seeing it from other respected experts. So this morning, I saw an article on Zero Hedge about a Goldman Sachs market strategist, and I thought I would share some of his points about why he sees the market's downward inflection point in April as over and things once again leaning bullish. His name is Scott Rubner, and his argument in a nutshell, it says, is pointing to Thursday's explosive move higher as testament of the market's extremely negative sentiment and why low positioning, which of course was followed by Friday's rout, the Goldman trader thinks that global stocks will rally significantly in May as the flow of funds is set to improve starting on Monday, today, even though the closely watched 50 basis point rate hike FOMC meeting is due on May the 4th. So Rubner has a bullish 11-point checklist, and I'm going to pick out some of the ones that I agree with the most. So he says, U.S. corporates return back to the open window on Monday with dry powder, $5 billion of demand per day every day until mid-June. U.S. corporates are the largest buyer of equities in 2022 and have authorized record year-to-date purchases. They've bought $90 billion of Apple, $70 billion of Google, $60 billion of Microsoft, and $50 billion of Facebook, etc. He also said pensions flipped to buy, given the recent outperformance of bonds versus stocks. This should carry over into next week. He also said the sentiment is the most bearish since the market crash lows in March 2009, which is something I also follow very closely and use as an almost perfect indicator of when markets are going to turn. When that bearishness becomes maximum, it really is a good indicator that things are going to change. Rubner says that he has done more bearish Zoom calls these past 2 weeks than he can recall. And the AAII bearish reading was 59.4 today, which is the highest level since March 5th, 2009. And the S&P rallied 8.5% in March 2009 and 9.39% in April of 2009. That was the generational market bottom. He also says money market inflows logged a massive $60 billion of inflows last week, which was the largest weekly inflow since COVID 2020, and that's typically another fear gauge. He also said that Goldman's Prime Desk notes that hedge fund exposure is dismal. Gross and net exposure, meaning they're not long stocks, they are short or not owning stocks, they could be in cash. They're at 2-year lows versus the past 5 years. That's a very big change for hedge funds. He also says everyone is short. Short leverage with options ranks in the 98th percentile in the last 5 years, which is why I'd been saying all year I think the crash is actually going to happen on the upside. Because all the hedge funds are short, when this market takes off like a rocket and people don't expect it, it's going to cause the shorts to lose money. And the shorts have unlimited exposure because when you're short a stock, You borrow it, sell it, and hope to buy it back at a lower price. If the price goes in the wrong direction and it goes up, you have unlimited loss potential. So as the stock market rockets higher and people don't expect it, I think that the crash that everyone's talking about that will happen is actually going to be on the upside, because what I have coming up is a very strong period for stocks in the very near future. So I'll leave you with this final thought from his report. He said, market returns after such extremely negative readings have been uniformly bullish, and the hit rate 6 months after such a reading is 100%, 14 out of 14 occasions, leading to a median 19% return. Meaning after extremely negative periods of time in the stock market, the market has always turned bullish on 14 occasions that he has been monitoring since 2009, and the median return is 19%, meaning half the time it's higher and half the time it's lower. But I think since we've had such a dramatic pullback this whole entire year, that the upside is going to be more dramatic than we're expecting. And I'm calling for a very bullish market. And I also think that we have a very bullish cycle coming up that I'm seeing that's going to continue for an extended period of time. So what I want to say is, for anyone who's feeling a little bit queasy, a little bit scared, that's normal. That's what bear markets do. And that's what deep corrections do. And it can be one of the best times to invest if you have spare cash. While it's hard to say day to day what the volatility will be, I think there's a very good chance that we may have seen the worst behind us. But nonetheless, if we get a few volatile days, hang in there, because the sharp rebounds is what we're looking for. That's where you get the big return, is by staying in and getting the rebound. You want to focus on the long term, not the short term. Yes, we may have more short-term volatility, but longer term, I do have a very bullish cycle in my cycle work. And number 3, this Fed meeting on the 4th, while everyone is still expecting them to increase rates by 0.5%, they'd be crazy to increase rates by 0.5% when we're looking at a negative GDP month, and they realize we're facing a possible recession. That just doesn't make any sense. So for anyone who's still expecting a 50 basis point hike, that would be new behavior for the Federal Reserve, because I can't remember a time when we were having negative GDP that they raised interest rates by that much. My forecast is no more raising of interest rates. I think that may set off this strong bullish rally that I'm foreseeing coming very soon. And that would be great news, because it would be unexpected news in the market. The bond market would rally, interest rates would come down from that, and that would send stocks flying. So hang in there. The correction may be over, or we may have a little bit yet to go, but not much. In my opinion, it's worth staying put, holding on, hanging in there with diamond hands. I have a new webinar that I'm going to be doing in May, and if you'd like to be notified about my webinar, it's going to be forecasting the future of the market and why I'm so bullish. Sign up on my website. You can enter your name and email on the pop-up box at my website, lindapjones.com. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.